Welcome to the Gray Report. I'm your host, Spencer Gray. And again, another episode packed full of useful information, kind of the latest news, research reports, data, all the new information and topics that you need to understand what's going on in the multifamily industry, real estate, and the economy. A lot of volatility in markets, multifamily market strong as always. Again, really great stuff in the Gray Report newsletter. Let's just get into it. All right, let's go. Okay, once again, bringing in Director of Communications and Marketing here at Gray Capital, Matt Bosnagel. Matt, today is Thursday. The Gray Report newsletter came out this morning at 8:30. I think, we're about 2,600 people got it this morning, something like that, plus or minus. Always amazing to me, like almost no one unsubscribes to the newsletter. We assume we get like unsubscribed. Someone's like, I didn't know what I was signing up for. Not at all. It is very well received. So thank you for putting together a great newsletter. How's your week been?
It's been great. I think it's been an interesting week, but I think there's been a lot of interesting weeks, especially in this summer. So I've been doing great. How have you been doing?
I've been doing good. Thank you. Yeah. Interesting week. Interesting times, exciting times. I'd say, if you're someone who follows markets, is interested in the economy, you're a real estate investor. This past year has been a little over a year, has been a roller coaster in terms of, trying to deal with the emotions of, fear and opportunity and risk and then just because we're in a totally new kind of economic paradigm and things are moving so quick, it has been a challenge to keep up. And that's where I think the newsletter and what we're doing here and grayreport.com is really a great tool for a lot of people to try to stay up to date and on the leading edge. Because I can tell you, if you knew how rents were moving a couple months ago and even today, because you were on top of it, you would be able to make certain decisions that others who didn't have that information would just not be able to make. Your assumptions would be stuck in the past rather than more forward looking and kind of really actually looking at the reality. Because when we see, I think 16% average year over year rent growth for the entire country, some markets, 20% plus rent growth. If you are, underwriting way under that, there's no way you're going to win deals, win opportunities. But then it's a balance of not being too far over our skis and assuming too much growth, because like we're going to talk about a little bit later, certain amounts of growth is just unsustainable. You can't be growing too hot. It just doesn't work out and you're going to see some kind of correction and it's unhealthy. But yeah, crazy week, crazy year, crazy times. It's exciting. And that's why we enjoy doing this, I think, every week. So Matt, what was going on with the newsletter this week? Again, it was excellent as always, but you had it's not a new theme, I would say. We're somewhat familiar. This has happened again over the past 18 months, many times, but stock market volatility, multifamily strength. Break it down for us, Matt.
Again, stock markets are volatile. Again, multifamily is strong and really stable. It is shown, and we'll show you the graphs here in just a few minutes. But multifamily specifically has just been growing and doing great. And the stock markets really for the second week in a row have been up and down, and it seems like a lot of, especially for September, they've been dipping down and recovering more than they've been surging upward and kind of settling down. So there's been some volatility, almost a little bit on the negative side for September when it comes to stock markets, and even the bond market has been a little bit crazy, which is a little bit more a little bit more relevant. I'm sorry, for the multifamily and commercial real estate industry. But that being said, it's still kind of an oasis of stability in an otherwise fairly volatile kind of economy when it comes to stock market, that is. So it's good to be in multifamily right now. I don't think that the stock market volatility is catastrophic. It is just a sign of this kind of a recovery. Recoveries are probably going to be a little bit volatile, but it's been very fortunate for multifamily investors that they have been able to ride and ratchet up instead of kind of have this roller coaster ride where they don't know what's going to happen week by week. Mhm.
Matt, what do you think, in terms of all this volatility? Is it more concerns over the, Delta variant, other variants? Is it that there's, the whole debt limit, the debt ceiling debacle's
Oh,
coming
oh,
up? But also, could it be, bond 10 years rising? Are we seeing just slower growth than anticipated, higher kind of inflation, but not as strong of growth? So this talk of stagflation.
yeah, I was.
What is it? What is it? What's
Yeah,
causing all
see,
the
I
concerns?
wasn't.
China, Evergrande. There's a lot of stuff going on.
Exactly, and I laughed only to suggest that there was one thing that that can kind of explain volatility. I think if there was maybe a dominant story, at least one that I kind of clued into, it was the bond rate or the 10-year T note fluctuations. That seemed to kind of drive a lot of volatility this week. Last week it may have been Evergrande, but again, there is that specter of Delta and worries about inflation, which is separate but related to interest rates. So I think that there's a lot behind the vulnerability of the stock market, maybe, but the proximate cause, if I could point to one thing, is this short term, really a 5-day run of increases for the 10-year Treasury notes. The stock market, and this is just to kind of summarize what happened this week, the stock market didn't like that 5-day straight 5-day straight of increases, and there was a little bit of a shock, and then it quieted somewhat after there was a little bit of respite from these increases. But again, it's sitting at like 1.54%, which is 21 basis points above last week's 1.33%. So stories about stocks edging higher towards a rebound are a little less encouraging to me with this backdrop of high bond rates.
Yeah, it definitely, when you change that discount rate, it definitely affects markets. That's why many folks consider that, the 10-year Treasury to be, one of the most important numbers kind of in capitalism in general. It's linked to so many different types of financial calculations and instruments. And really what we're looking here is not necessarily the rate itself, because 1.54 is not anything. I mean, it's stupid low historically. I mean, again, if, zooming out, I mean, we're still, very low. You see this long-term
Yeah,
trend line, but it's more of the direction and the velocity.
yeah.
Because
And
yeah, so go ahead, Matt.
well, yeah, and just a quick note, it is, like you said, worth putting it in context. And like you are doing right now, I spent some time like looking at, where is this graph going? What does it mean that we're what was it in 2019? It was 1.54 was about the low point for
Oh yeah.
2019 for pre-pandemic years. And then in March of this year, it was hovering around 1.7. So 1.54, the number itself is not necessarily the worrying part. It's the trend that is this going to keep going up. And I think that's what people are worried about. I think that against this worrying trend, Jay Powell has been very consistent in his efforts to keep rates low, but he's facing some headwinds here. And I have a question that maybe betrays my slight ignorance of all the intricacies of the bond market. But why can't Jerome Powell just say, all right, it's 1.54. We're going to keep it at that. That's the rule.
Well, they don't. He's not. He doesn't have. They have influence over the 10-year, but they don't really. They don't set. They don't set the rates. They're moving the Fed funds rate, which affects other rates. But it's the market that
Yeah, the
moves
bond
10-year.
market.
Now,
Yeah.
but now the Fed can buy a bunch of 10-year treasuries and influence the price that way. But a lot of this, it's a steepening of the yield. It's a steepening of the yield curve, which we want the yield curve being steep is usually a good sign
Mm-hmm.
for the economy. We can look again at another one of these Fred charts, and I'm going to bring it out quite a bit historically. So this is
Well,
the 10-year minus the 10-year treasury minus a 3-month treasury. So we're really looking at the very shortest end of the spectrum. Now looking at yield curves, because a lot of times, when the yield curve inverts, it predicts a recession, which has been pretty good. Let's go back even further. So before, kind of the early 90s, yield curve inverted in 89, and then we had a recession, in 90. Yield curve inverted, in 2000, and we had a recession in 2001. Yield curve inverted in 2000, first in 2006. We, had great financial crisis in 2007. Yield curve inverted in, to April 2009, and lo and behold, we had a recession in 2020 related to the coronavirus pandemic, but most people were more or less anticipating some kind of correction. But on the other side, so you're looking forward to inverting, but we want to what happens in a recovery and what a recoveries look like. And so, and look at all of these, in all of these circumstances, the yield curve was already widening. A lot of that, mostly because the Fed was bringing rates to zero when we're all of a sudden in time of recession and illiquidity and issues going on in the economy, and so that widens the curve, and then it continues to widen as growth picks up and the 10-year starts rising. And all of a sudden, when you're kind of getting at this peak growth, it's really when the economy is starting to really perform well. I mean, until it starts declining again, kind of peaks, and then eventually works us down until we hit another recession. And that's what happened over this last run. It widened, and again, look back, who wouldn't want to be buying assets in 2010? That would have been a great entry point. 2002 would have been a great entry point, assuming you sold before the great financial crisis. So trying to get a little bit more perspective. Obviously, you have to look at, there's no one set of metrics that can predict the future, but we can kind of look at it and say, all right, this sort of kind of makes sense, even though the coronavirus last year was absolutely insane.
Well, and that's kind of what I wanted to get at too. It was a little bit of a rhetorical question of, the Fed isn't in control of everything, obviously. And some of this stuff that we're seeing with bonds is a sign of recovery. It may not make things as profitable, but it is also a sign that things are doing well. And so I think that anything that happens sharp, like a sharp increase or something, is maybe worth a little bit of alarm, but I'm not seeing a whole lot of alarm bells, whether it's about the stock market or about the interest rates right now. So I think that it's a short-term thing, but again, I still think it's worth watching.
The other thing we didn't mention, Matt, is the idea of, and this is related to the debt ceiling, but the prospect of the the $3.5 trillion or whatever, the spending bill reconciliation.
Well, that's part of
if that doesn't happen, a lot of that spending has more or less been priced in to the market, to the stock market, and now all of a sudden it's like maybe they're not going to get there. Maybe that all doesn't happen, and that's also that could be pretty significant. Now that wouldn't necessarily. I would think that would maybe even bring bonds lower, because you'd think that bonds would rise with more growth. But it's just I think it encourages this kind of risk off sentiment in the market of like, all right, there are enough factors going on, only one or two of them have to hit, downside, and see that actual 10% correction, which would be much more meaningful than the like couple percentage point, reversions that we've seen recently. Okay, Matt, I want to talk a little bit about multifamily, just a little bit, getting a little less macro, but there's a transition that I think is appropriate, and we were talking a little bit about this, and it's related to Janet Yellen and Jay Powell. They were up on the Capitol Hill last week, or no, it was a couple days ago, this week. Good, we're on top of things. And Janet Yellen had made a couple statements that made my ears perk up when I was listening to it, and they did not really gain any headlines that we could see, because everyone was focused on the debt ceiling and the debt limit, but it had to do with housing. And I'm just going to read the quote that you pulled out, Matt, because this is kind of what got me kind of just thinking about what it meant.
Yeah.
So for the relief dollars not yet out the door, Treasury is doing everything it can to expedite their delivery. And now we're talking about rental relief dollars that was passed in the CARES Act and all coronavirus spending last year. The Emergency Rental Assistance Program is one example. Prior to the pandemic, there was essentially no national infrastructure to get money from government coffers to renters and landlords. Building that infrastructure has been a massive undertaking for states, localities, and tribes. This program is scaling up quickly with 1.4 million payments made to help struggling renters keep a roof over their head. Now, Matt, when you're making show notes, you pulled out the exact same key
Yeah.
trigger words that I did.
Yeah, there was a trigger word. Yeah.
That's the infrastructure.
Yeah.
This is not, so it's not short-term emergency programs that are going away. We're building infrastructure for an extended period of time. And obviously there's going to have to be an evolution in this, but what I heard is that this rental assistance is going to be, or could be, part of our permanent framework and part of the kind of the safety net that's coming from the federal government itself, similar to unemployment insurance, sort of, in a sense that, like, you lose a job, okay, well, there's a government-backed program that's going to at least kind of help you bridge that gap.
Mm-hmm.
Same thing with now it's going to be, oh, I've lost my job due to whatever circumstances, not outside of my control.
Yeah.
I'm sure there'll be different check boxes than there are now. Now it's related to the coronavirus pandemic, or if you are in fear of becoming homeless, there's going to be similar sets of check boxes. And if you can't pay rent, you can apply for the rental assistance that will probably be done through some local agency. Maybe that's how it's being done right now. And so what are the effects? So this is not and Matt and I were having this conversation just before this. It's not this is good, this is bad. Let's just talk about what those effects are going to be. And to me, it's like, okay, so delinquency should decrease significantly, because you're basically only going to have people who aren't seeking out rental assistance. They can't pay and they don't go get the assistance. So, but delinquency should decrease significantly, mm-hmm. or at least materially. And then occupancies will rise, which that's we've already seen that over the pandemic. Over the past 18 months, occupancies have increased. The market's even tighter because people who may have been evicted or may have left are able to get rental assistance, so they're going to stay a little bit longer, at least staying through the length of their lease, less early terminations. So and the result of that is rents go up, which is not great for housing affordability. All those things are great for apartment owners. It's really not great for the renter itself, who this is supposed to be helping.
There's a lot of questions, and I think that part of my leeriness is because it is taking control of the situation away and putting it in the hands of the federal government, which like you said, it could be good, but it just raises so many more questions. And basically, the government is, and you're proposing, and Yellen is really mentioning a system in which struggling renters get their rent paid, not their evictions prevented, but their rent paid, which is what we were talking about, months ago. But would this lead? My question is this going to lead somehow to greater government control of rent prices down the line? Is this going to result in regulations? And what you mentioned earlier in our discussions was are landlords maybe going to be forced to buy a form of insurance, maybe to subsidize the rental assistance program? As far as I know, the federal government doesn't just like to hand out money aside of the pandemic stimulus check. Usually there's some kind of strings attached, or some kind of, and even if they were handing out this money, especially if it's for a purpose, it's also implicit control of that that situation. So that is what makes me uncertain, and it does, it seems like a very complicated situation that could result from this.
Yeah, I think so too. So I think in short term, it could be beneficial to residents who can't pay or having a hard time paying, beneficial to the owners, landlords. But long term, I think there could be some negative unintended consequences that far outweigh the short term benefits. And then, what are the real negatives to the industry are? What are those strings attached at the end of the day? Because I think, they're not just going to be handing away free money when they think they can get something for it. So and again, so it's not, we're not saying it's good, it's bad. It's just saying it is what it is. And again, it's just because once those institutions are created, it's hard to put the genie back into the bottle. Institutions protect themselves. They want to survive and continue. People get hired. There's jobs that don't
Yeah.
want to lose those jobs. And again, that it's that word infrastructure, that this isn't going away. They put all this time and energy figuring it out. And I think the end result we've discussed is that long term, it's going to turn multifamily much in commercial real estate into much. The return profiles are going to look more like bonds, and in terms of the prices are going to be driven up, cap rates are going to go down, because there's going to be the returns are going to be that much steadier.
Yeah.
They're also steady, but they're going to be even less volatile, because it's like, no, the income is partially guaranteed. And so
Yeah.
everyone's going to be like, okay, that to them, they're like, okay, the risk has gone down. They're going to capital is going to pile into it, and the risk goes down, so return's going to go down. So again, if you're invested in assets right now, it'll be a great opportunity because your assets are going to increase in value. But on future opportunities, there's going to be less upside, and it's the return profile is going to change. It's going to be hard to do 8% cash on cash, 10% cash on cash. You're going to be lucky to get 3 to 5% cash on cash, because people are going to be looking at it more like a bond, that is backed by the federal government in a way, because usually your debt is guaranteed by the federal government through one of the agencies, and now the income is almost going to be guaranteed
Yeah.
by the federal government. So yeah, I think the federal government's going to say, just like they do with whether it's ADA or any of the other kind of through HUD, here there's a stipulations. You want to accept federal rental assistance, this is what you have to do. Or it's like, no, you're actually going to be required, just like employers are required to have unemployment insurance. You got a conventional market rate apartment building, you have to buy this special government backed rental assistance insurance, or whatever, of vacancy insurance, whatever it is. So it'll be interesting. We're just speculating, but again, that word infrastructure made me believe that this is not going away. This was not framed as in short-term emergency measures that are temporary.
Yeah.
Janet Yellen used to be chairman of the Federal Reserve. She knows how to pick and choose her words, right?
Yeah.
Like
oh yeah.
So
and like I said before, and there is going to be, the next time they talk, it is worth just doing a rhetorical analysis of this, because it does carry weight and they know it.
mm-hmm.
And you're
and also
right there.
It's important to read past the headlines and actually
Exactly.
listen to it, read the transcript, because no one's like what we're talking about. I don't think there aren't any articles about that.
Even Janet Yellen herself kind of sandwiched, bookended her comments. She was using, and you said at the beginning, this is just an example of these things, because she was using it almost as a debt ceiling is the headline.
Yeah,
headline.
I forget how it led into that, but she was using as an example of, we had to do all these things and this is still going. And okay, Matt, let's get into Apartment List, the national rent report that just came out. Apartment List, they put some really good research together. We're hoping to get some of the Rent List researchers on the Gray Report sooner rather than later. Let's send them out the invite.
I'm not ashamed to admit that I was kind of excited when I was like waiting for the end of the month, when the Apartment List rent report would come out. And having covered the volatility in the stock market, it again, like I mentioned up at the top, it is reassuring to turn to multifamily and see this continued strength in the apartment market. Rents have continued their sharp climb. You see that huge incline, and the dotted line representing where rents were projected to be outside of the pandemic, and now it has just surged above and beyond where the projections would have otherwise indicated. I think that one of the notable things that the report talked about was, and I'm kind of skipping ahead here, is they noted Spokane, Washington, and Boise, Idaho as these markets where rents have, since March of 2020, have increased 39%. Now this is not year over year, but still 39% since kind of the beginning of the pandemic. Now last month, in both of those markets, rents were down slightly. And they're saying that these markets are kind of like the exception that proves the rule. But I think that there's a little bit of a lingering sense is that, does this represent some kind of limit to what renters pay? Is this a sign, or is this almost like a model of what will happen and how we will see our way out of this sharp incline in rents? Because I get an uneasiness if rents keep growing and growing and growing. There's got that doesn't make me feel as good as a kind of more steady,
it's
steady
not
incline.
yeah no I think it's a good point, yeah, because it's that type of growth is not sustainable. I mean, I'm just looking, from the apartment list report. I mean, 39% year over year rent, or since March of 20
Yeah.
in Boise. Tampa 36%. I've heard anecdotally, and again, so that means that there are some properties that are over 30-40%,
Yeah.
and others some that are under. I've heard, yeah, in Tampa, and this is not someone in the apartment industry, just somebody knows. So, but the rent doubled year over year. You were paying $1,200, now it's $2,400.
Wow.
And again, and so what I think you're really getting at, Matt, is, are some of these markets, are they canaries in the coal mine a little bit? Are they kind of giving us a little bit of a look into the future of what's going to happen nationally in other markets, which I think is a good point and worth paying attention to. But then we have to just differentiate just the different drivers in all these markets. I do think that they probably are a little bit of a canary in the coal mine of leveling off from the extreme growth and having a little bit of correction before we work our way, kind of the stable, normal growth, whatever that is, probably still elevated. But it's very local.
Yeah.
I just would make this point real quick, is that, I think for like Boise and Spokane, I think that really it's the story. They have specific market stories of those markets turning into different types of markets, of where they just didn't have all these San Francisco, California, huge tech, industry population. They've just, tens of thousands of people just bam transplanted into the city, and it's a different city. It's just pricing is different.
That's a good point, and that's what I was going to mention when
So I think that there's a story there. And that's where, I mean, all these are markets of where, it's Idaho, Tampa, Florida, Spokane, Nevada, Gilbert, Arizona, Glendale, Arizona, Mesa, Arizona, Chandler, Arizona, Jacksonville, Florida, Fresno, California. These are all places that people are moving to from extremely high cost of living areas. So they're Fresno, so they're moving out of Bay Area to Fresno. They're moving out of California to all these Arizona markets and Washington and Idaho. People from New York moving down to Florida. So it's all these migration trends that we talk about a lot that are worth, you have to follow. So, and so I think that things will level off. I think we've seen that I think we're going to see that in GDP growth, sounds like, the end of the year. And we're just, it's still elevated. It's just that, like, it's not, and again, it's not unsustainable, because there is a certain level of growth that is just unsustainable. Like, again, like, unless incomes and wages are rising at 20, 30, 40%, or it's like the entire population is being replaced with workers who just earn that much more income. It's how do you charge 40% more in rent if incomes have only gone up, 6 or 10%.
Yeah.
So that's hard to square.
It's true.
This is a great report, Matt. Apartment List. They had some interesting tools and features. Anything else you would like to highlight?
I just wanted to know, well, not necessarily on the Apartment List rent report, but more on the I wanted to note this RealPage report that speaks to the demand that we're seeing, and the way that, we're looking at the future, investors and especially developers, and they're not going to agree to build something if they don't see a market there. And so, yes, demand and rents may level off, but the people that are willing to put up their capital and start these large multifamily projects are making bets, and they're saying that this demand is going to continue. And I also wanted to mention this report here, because it runs counter to some of the narrative that we're seeing around supply and labor shortages. Permits and starts don't necessarily mean that these multifamily buildings are going to enter the market right away. But it is a strong example, like I said, of intent and opportunity. People, companies, investors, they want to build, they want to move forward. Um, and also notable in this report, and you're kind of bringing it up right now, is this difference between multifamily permits and single family. When it comes to starts, permits, and completions, multifamily far surpasses single family homes on a percentage basis. Now, when it comes to numbers, single family numbers have multifamily beat when it comes to unit numbers, but still, when we're talking about the proportional increases, multifamily is surging ahead, and single family homes is essentially flat when it comes to people. So a lot more people are interested in building more multifamily now than single family, and so there's a big opportunity there. Again, these things take years to develop, but new supply is coming on the line, and people want to build.
Yeah.
So I thought that was very
Well,
encouraging.
I think you make some good points, Matt, because these aren't deliveries. These are permits. This is the intent, and
Yeah.
this is the demand of, okay, we know that there's a demand for these projects. When they can be delivered is an entirely different question, and we'll just have to see, because materials and labor are they're shorthand. I mean, it's hard to get it.
Yeah.
It's hard to get the workers. It's hard to get the labor. It's hard to get the materials. I mean, there's a chart somewhere about all of the ships off of the California coastline, because you can't get people to load the ships off the docks. I also heard a story that there's so much demand that the containers are in so high demand in China that they are in the freight, the price to ship something from China to the United States is double that to ship something from the United States to China. And
Wow.
there are these incentives to get the containers back to China. And so there are ships from the United States going back to China with empty containers because they're making more money just sending empty containers back.
Yeah.
And then can't unload them here in the United States. And so all these ships are just sitting there, off the coast. And, that's not making things any easier from a supply side, which is what is, again, it's just where these bottlenecks. It has nothing to do with the Fed printing money, although that doesn't necessarily maybe not help the situation, but it's these natural, just the bottlenecks that it's like, hey, we only got so much of this stuff. Who's willing to pay me the most for it?
And there is a kind of, this is like a minority story about kind of reshoring, which is to say, like, bringing some production and manufacturing back to the industrial sector in America. And that, that's happening. And I think it's happening almost like necessarily.
Was it Made Back Better here or something? Or
I'm not sure. Build back better.
Build back better here or something.
But it is, it is an interesting trend. And what scares me the most is just thinking about the complexity of logistics and how many people are involved in, and really China's big advantage was they had this logistics nailed. They had, factories within the right proximity where things could get built very efficiently, and shipping it over here. And I, to bring some of it to America, that could be a good thing. But this little hitch, it means in the short term, especially, we've got a lot to dig out of. And
yeah, because all of a sudden it's like, okay, maybe it's cheaper to theoretically manufacture in China, but if you can't get the stuff, how expensive of a problem is that? And all these car manufacturers who can't get the semiconductors. I mean, I just heard, the updated number to the amount of losses that the semiconductor shortage is causing, like the auto industry.
Yeah.
I mean, it's billions upon billions of dollars. And so, all of a sudden in their calculations of like, hey, should we offshore this or do it, in the United States or wherever? If you take all of a sudden these risk factors into place, all of a sudden it's like, well, that value is maybe not as good in China, because if we're gonna have to pay more because we can't actually get it, what's the point in saving, chipping off a couple cents here or there, a couple dollars on a component if you can't actually get the component? And China's gotten more expensive, and Vietnam's had its own issues. So I think and should be overall good for the U.S. economy. Our supply chain should be better. Assuming that like it's not I don't like it. I wasn't a big fan of the the trade embargoes and
Yeah, that's not the way to
the
do things.
trade wars. Yeah, it's not good for economic activity. And I think you know capitalism is exciting because it creates this opportunity for globalism, because it's a little bit cheaper to make something here and there's something there, and you can end up getting a cheaper product and deliver a cheaper and better good to somebody. I think that's like a good concept, and we shouldn't like forget about that, and not only be like we have to do everything here in ourselves, because we can't do everything. Just like in
Yeah.
any type of trying to do something, you need partners and people.
Hmm.
But if it makes sense to do it here, why not do it here?
Yeah.
Pricing makes sense.
Well, and
Win-win.
just to bring it back to multifamily, it does seem like the logistics itself, not necessarily any one product, but the process of moving things from one place to the other, all those hitches make me the most scared about the completion times and the price. And I think that's another thing that I often overlook is, yes, the price of things are up, but with these labor shortages, the completion times are getting delayed. And that's just,
yeah.
If you can't bring it online, then it doesn't matter what price it is, it's not online in time. And so that's really exacerbating the shortage significantly. And I'm not sure, I haven't heard an easy answer about what's going to happen with these labor shortage, because it's people that are moving these things. I really, maybe we'll get robot ships out of this, but not right away. But yeah, there needs to be a lot of people that need to that go into bringing more multifamily online, and it's going to be very interesting to hear about what people's answers are.
Well, and think about it. So we're talking about basically new development, new construction. Think about all the value add projects. When you're looking at a value add business plan, if that thing goes slow. If you've got empty units, they got to get them renovated. But if you can't get the stuff to renovate them, let alone fix them up to bring them online, either you're not hitting your numbers, because you're not getting your rent premiums, you're not executing your business plan. And in today's market, you have to pay up for those value add opportunities, because some of the upside's priced in.
That's
cash flow is
very good
already
point.
skinny, and so there's already like a renovation risk in doing like a big value add. And now it just and we had stopped doing huge value add lifts a couple of years ago, just because we thought that there was just a better risk return elsewhere in the multifamily market. And I think that everyone invests in multifamily in the past couple of years is doing great. So but right now that calculation is even there's even more risk, and for me, if I'm going to spend, it's no longer you can spend 5 to 10 grand a unit to do a big value add per unit. You're gonna have to spend 10 to 20 and to get a when there's already a $150 to $400 organic difference between market and in place rents. Are you really going to get that much more by spending that much money? I mean, obviously you need to maintain the property, but like if you could get $150 just fixing the place up in terms of curing deferred maintenance versus throwing a bunch of money at to throw in a granite countertop, you're going to probably make it $50 more on the granite countertop, but that ROI is going to be trash. Again, not to paint with a broad brush, but those are just harder to execute, because again, you can have the best plan in the world on paper, but you can even have the materials. So you have the people to actually install it and get it done.
Well, it's crazy too, because I mean, value add was like, that was such a byword for multifamily, and that was such a prominent part of discussion. And now it'll be interesting to see how much that discussion shifts to other
well, and I think we're always looking for ways to add value. You have to be adding value some way, but in the traditional sense of we're going to go in and spend 10 grand a unit and we're going to get $200 or $250 rent increase. I don't think that's going to be just like the cookie cutter strategy. I mean, and I don't think it necessarily has for the past couple of years, but right now it's even harder. Again, just as an example, we were touring a beautiful property yesterday, built in 2014, great market. Organically, their rents have just grown by like $300 between their lease rents and their like average lease rent and then their new market rents. But they're doing this, so organically they're moving, but then they are doing this other value add component they're adding these, and I posted this on Instagram. So if you want to check out the Great Capital Instagram, you can see a picture of this. But they're adding these like little private yards, like on the first floor units. This is a garden style property. Where, when there's a little bit of space outside of their unit, they're fencing it in,
I like that.
and they're putting in they're laying down gravel, and they're laying down turf on top of that, artificial turf. And so whether you've got kids or whether you have a dog, you've got this little, like, it's off your little like front porch, it's all fenced in,
Yeah,
you
that's
got this little
nice.
space that's your own. And they're adding $150 premium on that for those units.
You
And
know what?
that,
I kind of I might pay for. I would pay for that maybe.
I would, if you have a dog, you can like let them
Yeah,
outside. If you have kids, you can like, it's a fenced in area. I
yeah,
mean, you're expanding like essentially they're like livable space outdoors, but it's like essentially you're adding square footage, sort, not technically, but like you're adding more to their private space. They're getting $150. That's a similar type of rent premium you'd get if you're throwing, again, $10,000 per unit doing a full kitchen renovation. Why am I going to go in and do a kitchen when I can't get people to do it? I can't get, cabinets or countertops
yeah.
or appliances when I can just put up a little fence.
That's a good point. I wonder what kind of creative solutions we'll see for people to add value that really, that are the product of maybe some scarcity when it comes to,
Yeah.
the traditional approaches.
And this is all kind of relevant, just, how people think about housing post pandemic. If they want more
Yeah,
space, I know talking to developers are looking at, okay, how do we put in a little study room? How do we put in a little nook for a little office? Just maximizing the value of these spaces as they are.
yeah.
Yeah, so it's pretty fascinating. Matt, great newsletter.
This was
The
fun.
Gray
This was fun
Report.
talking.
It's always a pleasure. It's always a good time. I do just have to mention, people are probably wondering right now. They're like, how do I get this newsletter? You guys talk about all this these articles, all this stuff. And it is true. So if you hop on over to graycapitalllc.com, you can if you just click on the sign up for our free weekly multifamily news or report. It is a report. It's a newsletter. That's how you get the Great Report. Let me see a picture of me kind of blabbering on about it like I am right now. All we need is your email address. That's it. It's pretty simple. So hop on over to graycapitalllc.com /newsletter. You can just sign up right away. So one of the best resources I think in the industry is grayreport.com. It is aggregating all these great research reports on a daily basis, new articles that come out. Quickly scrolling down. Look at this content. If you want to stay up to date, have the best information, this is the place to do it. Everything that happens in the multifamily industry is essentially right here. Not only articles, research reports, new data sets that come out, live market statistics. We've got videos, podcasts, original content, as well as great aggregated content. Again, you can watch, us talking to, Noah and Jonathan from Berkadia, these great researchers, digging into this awesome research report that they had done over multifamily return volatility and beta in multifamily markets. A metric that not very many people look at, but I think that you probably should be aware of it. So again, all of this is coming to you from kind of the Gray Report, Gray Capital ecosystem. If you want to take the next step, besides just learning about this stuff, because learning about it is great, but taking action is kind of where rubber meets the road, as they say. GrayCapitalLLC.com. You can join the Gray Capital Investment Club. That's really the best way, and one of the only ways to be alerted when we have opportunities open to accredited investors. We're finding some really interesting deals, exciting deals. We're putting our own money into these projects, and we invite folks to invest alongside us and kind of be a part of the journey. To create some great, cash flow investment vehicles with a ton of upside, build some generational wealth, cash flow. We're all about it. That's what we love doing it. That's, again, living and breathing it. So check us out, graycapitalllc.com, Gray Report. Make sure you're on the Gray Capital or the Gray Report newsletter. And Matt, again, thanks a lot. A lot of great stuff.
Great. Thanks.
Okay. Catch everybody next week. See ya.